Hi guys, welcome to CA Inter Financial Management MCQs. I'm Anuj Jalota. We are on a mission to be doing every possible MCQ but adding a tinge of logic also. Obviously, MCQs cannot be mugged up, and MCQs are a way to be testing whatever you all have done, okay, in that entire chapter. Was that perfect or not? Okay, that's what we are trying to be doing. All our MCQs for costing are already there on our YouTube channel. All the full lectures, regular course lectures, free lectures come every Saturday, Sunday for costing. These are accompanied by complete solving of the questions. Apart from that, complete soft copy, rankings of every question, the summaries of every question. Tests are done at the end of each and every chapter. They ensure that one small thing, you can easily get 90 plus in costing. Okay, and in case you are serious about your studies, then try to make use of these kind of free resources. In any case, if you want to join our latest batch also, then the link will be there in the description, or you all can always call us on 8080324444 or write to us on our Telegram ID @AJNext. Let's start it off. Today's chapter is all about capital budgeting, investment decisions. And the question for today is IRR would favor project proposals which have, get me the four options, heavy cash inflows in the early stages of the project, okay, evenly distributed cash flows throughout the project. Third, heavy cash inflows at the later stages of the project. And lastly, none of the above. In case you all know the answer, we all have done around 3 questions like this. We have given this explanation also. In case you all remember the answer, time for you all to be commenting now. So, consider the following example. Okay, if somebody tells me find out the IRR, suppose there is some project in which investment required is 10,000. Okay, and there are 2 projects with me. Say project, in this case, project X and project Y. Okay, so you're going to be investing 10,000 rupees today in project X. Okay, the cash inflow that is expected at the end of year 1 is only rupees 2,000. At the end of year 2 is rupees 4,000. At the end of year 3 is going to be rupees 8,000. Now, if you use your methods and try to find out the IRR, or if you're good in Excel, then it will come in 1 second only. Okay. You can try to take 4 rows and you can write down minus 10,000, 2,000, 4,000, 8,000. And then there's a function is equal to IRR. Select those 4 boxes and close it. You will arrive at this IRR. Okay, this IRR will be 15.12% approximately. For project Y, try to be now seeing what cash flows I'm writing. For project Y, cash flow at the beginning of, the cash flow at the end of first year is suppose 8,000. At the end of second year, it is say 4,000. At the end of third year, it is rupees 2,000. So if you mathematically try to see project X and Y give you the same cash flows, 2,000, 4,000, 8,000. But project Y gives you 8,000, 4,000 and 2,000. Okay. If you now find out the IRR using your technique or Excel, okay, it will be approximately coming to 24.86%. Why does project Y show higher IRR despite having the same total cash inflows here? This is because of the ways inflows are generated. Inflows emerge towards the earlier stages in which project Y, you have a heavier cash flow, okay, right in the beginning. And then it starts to tapers down. Whereas in case of project X, okay, you will start to be realizing that in beginning the inflows are less and then it starts to be increasing. Overall, the cash inflow is same in both the cases. 8,000 plus 4,000 plus 2,000, that is 14,000. Okay, but IRRs are remarkably different. IRR always prefers those projects wherever the inflows are higher in the earlier stages. Okay, why does that happen? Might be because of this assumption. Okay, assumption under IRR method are inflows are reinvested within the project, inside the project at rate equal to IRR itself. Okay. Now, if you logically start to be thinking inflows are reinvested in the project at rate equal to IRR. If I go back to the example now, okay, you will start to be realizing in case of project Y, higher inflows are getting generated in the beginning. So therefore, 8,000 rupees gets reinvested within the project for the balance 2 years. Okay. Because the project life is 3 years, I've given the cash flows for 3 years. So 8,000 rupees gets reinvested for the remaining 2 years at rate equal to 24.86%. Whereas in case of project X, 2,000 rupees gets reinvested at 15.12% for a period of 2 years. Okay, obviously the accumulation of interest becomes very heavy for projects like Y, because higher inflows get reinvested for longer periods at rate also which is higher only as such. Okay, so therefore in this particular case we always say that IRR will always prefer those projects wherever the returns or the inflows are higher in the initial periods. You can test that for any question that you will have done. Okay, so therefore the correct answer in this case should be the first one. Heavy cash inflows in the early stages of the project. So IRR will prefer such projects only. Okay, that's it from my side for today. A is the correct answer. I'll see you all next time with another concept, with another logic. Till then, take care of yourself. Bye. Happy studying.